Welcome everyone. We're going to get started in just a minute here. We are going to get started. Usually wait about 5 minutes for everyone to get in, but we're not going to wait that long today since we're only doing 20 minutes here. I'll give you a quick introduction before we get started. My name is Trent Zimmermann. I'm the Director of Annuities here at BGA Insurance. And we've been doing these 20-minute trainings for agents here for a little bit. And now I've expanded out to a much larger market. So these are going to be weekly training sessions we're going to be going through either with product updates, strategies, positionings uh, to get you guys equipped to go out there and make some sales, maybe get some new ideas if you guys are already experienced. But just so you know, for this first round with this larger audience, we are going to be going back to basics a bit. So forgive me if there's stuff in here that you already know and have known for decades. But I want to make sure we're all on the same page here. So let me go ahead and share my screen here and we can get started. I know that we had good amount of RSVPs, but um, we'll get started without them. All right. You've met me, Trent Zimmermann, and you know BGA. We're a GA wholesaler of life insurance, long-term care, annuities, and disability. Now, if we're going to go back to school with annuities, let's just cover the basics here. What problems can annuities create? I want this to be known beforehand. The last thing I want to be is a hammer and everything's a nail. So these annuities are going to tie up money. There are going to be liquidity issues. There are going to be free withdrawal periods on many of them. But you have to know that going in that this is going to be a tool to lock up money. And because of that, you get some pretty great gains out of it for the right situations. And these may underperform. I'm going to tell you right now, I am not a fan of these volatility control indexes. A lot of them that we've seen have been getting zeros. I know they were hot in the market and people were excited. But we're going to equity-based indexes that have been around for a while, and we can see previous returns when we're making those recommendations. If you feel strongly about a volatility-controlled index, be my guest, but I'm going to recommend against it. Some have fees. And now these fees are also going to come with the riders. We're not going to be talking about income or death benefit riders today. We're going to cover them at a real high level. But today we're not going to be covering those. So these basic annuities that you're going to be getting from our distribution channel, they're not going to be having too many fees on them, if any. Most of them are going to be fee free until you start adding on those riders. Although some are going to have bonuses, I'm not a fan those because they suppress performance. But if you need it for a situation to get somebody out of a bad product, uh, they can be good, and those will have fees on them as well. Sold instead of solved. I mean, I really hope that's not this crew. That's not going to be us. That's not going to be the recommendations we make. When we're looking at this, we're looking for the right situation. And these are great tools. These are not hammers and not everything's a nail, like I said before. And wrong product chosen. That's where we come in. We're going to help you and be your partner along this process. But why we're fans of them? Guaranteed income for life. There's nothing else that can do it like annuities. And competitive fixed returns. We're going to go into that and see where they line up because there's a lot of talk out there that these are going to be better than your brokerage products and making huge promises there. And it's just not where they fit. We're going to figure out where you can position them well. Safe growth without risk. The ones within our distribution channel are not going to be able to go below zero. They're all going to have a 0% floor if there is some sort of index gain. Although you can lose money on the fees, um, these are going to be safe products that you're not going to be able to take the losses that you can get in the market on. We do have long-term care coverage on these annuities. We also have annuities that we'll talk about at a later date with income doublers that can operate in a similar space, although by no means are they long-term care and tax-free planning there. Uh, and then guaranteed legacy planning. So we'll cover that a little bit at a high level today again. And so we're looking for people who want income, want to de-risk their portfolio. You want competitive, safe returns long-term care plan in place, and maybe a legacy. That's a maybe. So what products are we talking about right now? Fixed index annuities are annuities where the crediting on your account value is based on an index performance. Those are going to have cap and par rates. We'll cover that in a second here. Uh, and it's going to have a 0% floor. Fixed annuities, you get a guaranteed rate. That's what you're getting every single year. You know exactly what you're going to get. Variable annuities are going to be in the market. You're going to see a lot higher fees on those. Some as low as 1%, but most between 2 and 5%. But you're going to have much larger swings like you would in the market. Uh, RILA's registered index linked annuities have come out and grown a lot in the last few years as a response. And those are buffered losses. So either you don't take the first 25% and you take every loss after that, or you take losses after 15%, or you take the first five and then you don't take anything else, or you take a percentage of the loss. There's various different ways they buffer them. And for the variable and registered index linked annuities, those are going to have higher fees. We don't sell those typically. There are a couple that can fit into our model, but those are going to be with your broker dealer bank system. And some of them can be competitive. A lot of them, because of the fees, are going to have a lot more drag, and you're losing the protection that you would have in annuities. And the risk reward on that, I'm curious as to why they're better than just being in brokerage. But if you feel strongly about them, show me your use case scenario. I'm happy to be proven wrong. Uh, single premium single premium immediate annuities are the classic ones. You put money in and you're buying an income stream. Now you can add things onto them to get your premium back if you die before you've collected that, or get period certain built in. Um, but we aren't seeing as much of these anymore now that fixed index annuities have built on guaranteed lifetime income riders. And then QLAC is part of the that SPIA realm, but you're able to defer your RMDs um, while you have it parked in that type of vehicle. It's very specific use case. Again, we're going to cover that in some strategy sessions in the futures, but I want you to know about them now. So where do these fit? What we're going to be talking about today is the MYGAs and the accumulation annuities. And where these fit is this Warren Buffett idea of it's insane to risk what you have for what you don't need. When you're close to retirement, do you need to be taking on this type of risk that and exposing yourself to sequence of return risk? A friend of mine works for State Street, and she was arguing with me that why would I ever buy an annuity? And I said, you shouldn't. You're 32 years old. You shouldn't buy an annuity. You're not near the point where you want to be de-risking your portfolio for that. But when you're looking at getting close to retirement, this is when you have that mindset of why would I put myself at risk? Um, so this also fits into Nicholas Crown's bulletproof portfolio, and it's a strategy of building wealth in ETFs or in Nasdaq, S&P, and then systematically de-risking it with FIAs and MYGAs. So why would you do that? Because MYGAs are fully guaranteed growth, and they're going to be your CD alternative. Right now, CD rates are between 3.95 to 4.35. MYGAs are hanging around 5 to 5.5. Now, we're going to go on a deep dive on some simple interest MYGAs because they can be extremely powerful for regular withdrawals, and those are getting simple interest up to 6.5 even. Now that 6.5, you lose the power of the simple interest, usually after the surrender period, because you aren't getting those compounded gains. But in short time periods, especially if you change it out after that annuity is at a surrender charge, which you should do for all of them because they're not built to last outside of that, they can be extremely powerful tools for regular withdrawals. And we'll do a deep dive on that at a later date. Now, when we're looking at MYGAs, I'm getting a lot of concern right now that rates are dropping. Are MYGAs going to be effective tools? Because we've had a lot of people buying MYGAs instead of the FIAs uh, and accumulation annuities in recent years because the rates have been so good. I sat down with a lot of carriers and how they built these just over a month ago, and all of them are linking to the 5 to 10 year Treasury yields instead of the Fed rate. So I want you to see that these do somewhat move together, but they're not closely aligned. It takes a lot of time for them to drop down to those levels, and right now we are seeing them meet uh, because it was picking up with the Fed rate, and now it's the Fed rate's dropped. But we are seeing some good resistance there if it drops further, so that these MYGA rates will be able to sustain for a while longer. And at the end of the day, if you have clients who are in these MYGAs who don't need that money yet to be turned into income, and they want to stay in this guaranteed space, uh, annuities, because of their structure, are going to be outperforming the CDs and the money markets. So it's really at the end of the day what we've got at the time. And if you're going to be selling MYGAs to people who have had them and are staying in that space, you're competing in a space that everyone has about the same structure. So I don't know if it's as much a worry right now as people think, but it is on top of mind. Now, accumulation annuities, these are going to be the FIAs that we talked about. And this is where I want to give some warning because the historical performance of these have been about 6.88%. And that's based off of a LIMRA study of the entire market. Now, that's including carriers that have terrible renewal rate integrity, who after year one are dropping down their caps by half. That includes the volatility control indexes, which has been averaging around 2%, and many of them even getting zero. So when we look at uh, annuities out there that have strong renewal rate integrity, publish their rates, and have high caps, can they get to 7, 8, maybe in a good option market, 9%? Sure. But as a statistical average, we're looking at 6.88%. Um, so if we look at the S&P, we're looking at 10.44. And this is where people start to make the argument. If you have fees associated with that and taxes, and are you actually going to be getting that 10.44? And can FIAs perform better? If the sequence of returns is right, yes, but that's not something we should be promising our clients. These are going to be the bond alternative. Of the bonds have been returning between 3.4 to 5.9% historically. Uh, and these FIAs are going to be performing a little bit better with that, but without the risk because they have that 0% floor. So let's look at positioning them against those bonds. If we look at those yields, we're looking at the 2020 to 2023 period where they could have dropped by up to 48%. So if we're looking at something that has a 1 to 3.5% delta better performance that isn't exposed to these swings down, that could be up to 50% of the bond price. We're looking at an extremely powerful tool for that bridge period between wanting to buffer your portfolio and de-risk it as you move into retirement. So the way this is working, if you weren't understanding what I meant with sequence of return, is these are going to be having cap and par rates. A cap is the maximum amount you can get back from that index, and a par is how much you are going to be participating in that index. It's going to be a percentage of. So let's take the S&P 500. If you had $100,000 in there and it went down, this is a real 2 year sequence, down almost 20%, and then up the next year 26%. You're getting at the end of the day 2% return over those 2 years in the S&P 500. In a 10.5% cap, you're getting 10.5% return over those 2 years. In a 60% participation rate, you're getting a 16% return on that. So that's when these products can be really effective, is when you have down market periods or bad sequence of returns. you can get a lot more return out of these products than you would just being uh, in the index itself. So when we're looking at these, we're also looking at adding on some strategies here, and these ones are going to be once again talked about later date. Once we're just doing a high level overview. Not only can we do add income onto these, we can add enhanced death benefits and that roll up with guaranteed growth over 7 to 15 years, and you can get up to 2.5 times your basis in death benefit. And so where do you use these? You can use these for postpones for life cases when people are uninsurable or elderly, especially if they have an excess of qualified funds. You can do flexible premiums on these, but it works a lot better if it's front end down. People have been using these for overfunded life insurance complements that if you're worried about hitting that MEC level in that 7 year period, you can dump this into an annuity and not experience that sequence of return risk. And then once you're out of that, surrender the policy and move it into life. And then as we've been talking about that bridge to income. So these are going to be the CD and bond alternatives just to bridge you to that period or once you're in retirement that you're saying, I need to have, I've already figured out my income. Now I need to say, I have a chunk of uh, my portfolio, a tranche that cannot lose money. And then you have a more aggressive tranche after that. So these also can be effective tools for protecting those assets under management, especially in the fee versions of these products. That if you're a money manager, you can say, I want an alternative to the CDs, to the bonds, that I'm going to buffer my portfolio with in that bridge period or in retirement already. So it's all I've got for you. I know it was a back to basics. And we're really just talking about positioning these products accurately and not offering the moon to clients and saying, this is the best thing since sliced bread and you're going to outperform your brokerage account and never have a risk of a loss. I know we're just doing the basics. Bear with us. We're going to be doing these every week on Tuesday at 11. And we're going to be going into deeper dives into strategies that I mentioned here and plenty more. Uh, and even as we talk about uh, income and long-term care as well that we didn't even touch today. If you have any questions or you want to dive into something that I just touched on before we ever go for another 20-minute Tuesday, I believe my contact information is all here. Here we go. Take a screenshot of this, pull out your phone, snap a picture there. You should all have my email from the invite as well. Give me a call, give me a ring. Happy to talk strategy with you and your clients. And with that, that's our 20-minute Tuesday. I'm going to give the rest of your day back to you, and I hope to see you all again next week.